I think all roads lead to gold when you look at it. We need the price of gold higher. We need the dollar weaker. We need defense industrial production back here. We don't want to be reliant on the Chinese to both finance our military and make our military. It's a bad idea. The only release valve is gold. Where's it going? I think it's probably going 15 to 25,000. The United States has probably never in its history, its number one export, be non-monetary gold for 2 straight months. Where's it going? Well, it's mostly going to Switzerland. Okay, well, that makes sense. It is the refining hub of the world, right? Where's Swiss been exporting gold to? China, the UAE, Turkey, India, and France. And Hong Kong, too. What that tells us is America is exporting gold through Switzerland to China. China imported 975 tons on net of gold last year. It values that gold to balance their trade at $38,220. China runs a flat balance of trade. What's the implication? The dollar gets waylaid.
Right.
The gold is now the reserve currency. The Chinese have been telling their people to buy gold since 2002. So the balance sheets of China and their banks, which need some repairing, given what's happened in real estate there, is going to go up a lot. I think all roads lead to gold when you look at it, whether it's deflation, whether it's inflation. We had deflation with where we are. You quickly have credit risk to Western sovereign bonds, Western bond market, and that's not going to be allowed to happen. If you have inflation, obviously. And so really gold is nobody's gold owned in physical form or an allocated physical form has no counterparty risk. And that's basically one of the only assets that you can say sort of has that, a monetary asset, certainly. So I think that's exactly what we're in the early days of watching, which is just this awakening to, it's not that they've run out of room to kick the can. They can always kick it further, but they can't kick it any further without really debasing the currency.
Okay. I interview regularly Andy Schekman, who's the co-founder and CEO of Miles Franklin. I don't know if you know Andy or not. My opinion, very knowledgeable guy about just the internal plumbing of the bullion market, because he's in there on a daily basis, buying, selling, et cetera. And he has really been shocked by the flows of bullion in and out of the major exchanges like the LBMA and the COMEX. It's just at higher levels he's ever seen in his career.
Gold isn't just a hedge, it's becoming a structural necessity. Luke Gromen points out that physical bullion bypasses counterparty risk, something paper assets can't claim, especially in a market stressed by sovereign debt risks. With deflationary and inflationary pressures colliding, traditional bonds could fail to protect capital, leaving gold as one of the few reliable monetary assets. Flows through the LBMA and COMEX are at career highs, signaling unprecedented global repositioning. Investors need to assess their exposure to systemic counterparty risk before markets react violently. Next, Luke Gromen highlights why these flows hint at larger structural shifts in currency and trade dynamics.
And not only are the volumes unprecedented, but the amounts that are being stood for delivery are unprecedented. And some of them are so high that he has trouble thinking it's anybody other than a sovereign player that's able to basically kind of purchase that much and take that much delivery in one fell swoop. Does that surprise you in any way, or does that make sense to you that countries out there are, yes, their central banks are buying them publicly, but also kind of on the sly, they're just taking more and more of this stuff?
No, it makes perfect sense. Something we've highlighted for clients 2 or 3 times in the last 2 or 3 weeks has been the United States' single largest export in October and November, which are the latest trade data, was non-monetary gold. And the Forbes magazine, their trade editor, wrote that was the last week. He wrote that those are the first 2 consecutive months in at least 20 years, and probably ever, that the United States' single biggest export was non-monetary gold. It was, just by way of comparison, it was bigger than aircraft. So
okay, and sorry, just to help a slow mind like mine understand this. So it's not an import of gold to America, it's an export outside of the country?
US gold exports are now the country's largest export, surpassing aircraft, an event unseen in at least 20 years. Luke Gromen notes that much of this movement is likely driven by sovereign players quietly absorbing bullion, reflecting strategic accumulation rather than market speculation. Central banks' stealth purchases highlight a recalibration of global reserves, bypassing traditional transparency. For investors, this means bullion supply dynamics could tighten suddenly, impacting both gold pricing and related equity sectors. Next, Luke Gromen digs into why these flows are reversing the traditional import-export balance and why Switzerland is central to the story.
Well, just in that direction, yes.
Okay.
There's imports coming in too. But I think it's really important signpost from the standpoint that like we've never seen this before in terms of the size of these flows. Earlier, in the first quarter of 2025, a year ago, we had so much gold coming in here in the first quarter that it literally turned GDP negative by like 4 percentage points. So you took a $30 trillion economy and turned it negative 4% because that's how much gold was coming in. So from where mainly the UK, I would suspect, but who knows? So we've seen these flows pick up, and the question is why? Why is the United States exporting a bunch of gold? And maybe more interestingly is where. So when you look at the data, where the United States has probably never in its history had its number one export be non-monetary gold for 2 straight months. Where's it going? Well, it's mostly going to Switzerland. Okay, well, that makes sense. They're one of the biggest refined, it is the refining hub of the world, right? 90% plus of global gold refined is refined in Switzerland. Okay, well, let's now dig into the Swiss numbers. Where's the Swiss been exporting gold to?
Turning GDP negative by 4% just from gold flows is a striking example of hidden macro impact, and Luke Gromen highlights that this isn't a one-off event. The US export surge to Switzerland, home to over 90% of global gold refining, signals a deliberate rerouting of bullion towards strategic end destinations, likely Asia. This challenges the narrative that gold markets are merely reactive. They're being shaped by large-scale state-level logistics. Investors should consider geopolitical and supply chain implications, especially for bullion-related ETFs and commodity-sensitive equities. Next, Luke Gromen maps where Switzerland is sending this gold and why it matters for global trade flows.
Yeah.
China, the UAE, Turkey, India, and France. And it's the Chinese and then Hong Kong too, which is also China.
Right.
And so to me, what that tells us is America is exporting gold through Switzerland to China. Why would we be doing that?
So the global flight of ounces of physical from west to east continues.
It does, and it makes me wonder, right? What happened in October? This is purely speculative on my part. Remember, the new trade deal went back into place in October. And our leaders got up and told us, hey, the Chinese have resumed sending us rare earths and critical minerals. If I'm the Chinese, I ain't taking paper anymore for that stuff.
Interesting.
I think some element, and forget out what I think, de facto, America runs a huge trade deficit. That is a fact. Another fact is that our biggest export for 2 straight months in the 2 latest months of the data, beginning when a trade deal started, was gold. De facto, the United States settled part of its trade deficit in October and November in gold. And I think that is when you listen to what U.S. officials like Trade Representative Greer and others have said, including at Davos, Greer came out and said, listen, we're going to start settling. We want to move towards a Hamiltonian economic system with a neutral reserve asset.
US gold exports are effectively paying down trade deficits with China, a move Luke Gromen notes could reshape the dollar's role in global trade. By routing bullion through Switzerland, the US leverages neutral reserve assets while sidestepping conventional currency settlements. This signals a strategic pivot. Trade imbalances are increasingly being settled with tangible assets rather than dollars. For portfolio watchers, it highlights potential upstream effects on mining equities, refiners, and currency markets. Traditional treasury yields may no longer fully capture exposure risks. Next, Luke Gromen explores how this reshaping could redefine global reserve asset dynamics and what that means for US-China trade.
I think part of the reason we're seeing gold's price move is I think trade is bidding up gold. When you look at U.S. trade deficit and compare it to the size of the global gold market,
Uh-huh.
The U.S. trade deficit dwarfs it. Dwarfs it. The price has to move so much.
Can I ask a really basic question here? This might be naive, but this is fascinating. So, assuming that's true, right? That they're moving to this model and would like to have this neutral asset to settle trade in, it would benefit the government to have the price of that asset increase because it means I need to give you less ounces in return for whatever I'm buying from you, right? And so historically, people that have followed the precious metals industry have grit their teeth, I think, for understandable reasons that precious metal prices are suppressed because the government wants to keep it down. It doesn't want to, have it reflect the decline in purchasing power of the US dollar or whatnot. Could this be flipping the script where all of a sudden the government actually wants a higher gold price?
100%. I think it's exactly what's happening. I don't think people have understood why the price of gold has been managed and suppressed for years. And it was to direct flows into US financial assets and in particular to treasuries. If gold got too big relative to the treasury market, then that's going to create a network effect for gold.
Gold's recent rally isn't just investor speculation, it's trade imbalances pushing the price higher. Luke Gromen highlights that the US trade deficit now dwarfs global gold supply, meaning every dollar of deficit exerts direct upward pressure on bullion. Historically, gold prices were suppressed to favor treasuries and financial assets, but a shift toward a neutral settlement asset flips the incentive. For investors, this could signal higher bullion prices and reduced downside volatility compared to other financial markets, as government policy may now actively support gold. Next, Luke Gromen explains why this shift changes the dynamics of US debt and currency flows.
It's not going to flow into treasuries. It's not going to flow into U.S. stocks, and that's ultimately going to result in a weaker dollar. It's going to result in weaker U.S. demand for U.S. treasuries. It's going to result in higher rates. Well, think about what this administration and the Biden administration before it. What do they want? They want to make more stuff here. They want a weaker dollar. They want they want all of they don't want the Chinese buying our stocks. Okay, well, if we don't want the Chinese buying our stocks, and the Chinese don't want to buy our treasuries, as we saw from the headline today, even where they're openly telling their banks to reduce exposure to treasuries. And the Chinese, by the way, said we're going to stop buying treasuries 13 years ago in 2013, and really have been winding them down ever since. The only thing left over to big enough is gold. And so I think it's a win-win where, okay, Chinese, surpluses against the US on the margin for at least some goods go into gold. Price of gold goes up a lot. The Chinese have been telling their people to buy gold since 2002. So the balance sheets of China and their banks, which need some repairing given what's happened in real estate there, is going to go up a lot.
The US dollar weakness and treasury demand are directly tied to the reallocation of Chinese surpluses into gold, as Luke Gromen notes. With China reducing exposure to US treasuries since 2013, the only sufficiently large asset to absorb their surplus is gold. This strategic accumulation stabilizes their balance sheets, while also benefiting US policy objectives like reshoring production and weakening the dollar. Investors should monitor gold's role as both a reserve and strategic asset, as traditional financial instruments may see reduced influence. Next, Luke Gromen highlights why this reshaping positions gold as the central pivot in US-China economic strategy.
That works for them. They can control that asset. We're not going to steal it because it's in their country. That works for them. It's inflation protected. That works for them. And for the Americans, we need a weaker dollar. That works for us. We want to reshore. Got to have the weaker dollar before we do that. We want the Chinese out of our country. That does that in terms of their money buying our assets. That works for us there. And, the nice little kicker at the end of it is once a gold price gets high enough, there's a provision on the books. Treasury can revalue the gold. It's just money creation using gold and buy back most of the Treasury market, certainly the duration. So you can control long end rates. It's a win-win-win. I think gold is the unspoken pivot of any deal that might already be struck, at least in the framework between the U.S. and China. It has to be. It's the only asset big enough. And critically, for who cares what I think, watch the flows. It's happening. Watch the price. It's happening.
God, this is so fascinating. So a ton of questions coming out of this, but I guess first and foremost, um, gold and especially silver just had, massive price run ups.
Gold isn't just a commodity, it's the unspoken tool in US-China economic alignment. Luke Gromen points out that high gold prices allow Treasury to effectively control long-end rates via revaluation, turning bullion into a quasi-policy instrument. For China, physical gold accumulation is secure, inflation protected, and strategically autonomous. For Americans, it supports a weaker dollar and reshoring production. Investors need to appreciate that bullion flows now carry geopolitical weight, not just market momentum. Next, Luke Gromen examines how these price spikes differentiate the current cycle from previous gold bull runs.
They've had a correction. Gold's hung in there actually surprisingly well. It's back above 5,000. I think it's close to 5,100 the moment we're talking here, Luke. And one of the fears that has been expressed over the past week or so is that correction's been going on is this going to be like what we saw in 2011 or in 1980, where we had this blow-off spike and then basically we gave it all up and then the precious metals just kind of did nothing for a long time. I think you think this time is different for the reasons that you just mentioned. True?
Oh yeah, it's night and day. It's apples and oranges. We were trying to get gold out of the system. We were trying to get the world to buy our treasuries and get, recycle their surpluses into our financial assets and get our factories out in the process. That's what we were trying to do in 1980, and from a policy standpoint, and from a in 2011, we were trying to sort of maintain that system. It's a matter of national security for the United States for the price of gold to go up, not down. In 1980, it was a threat, starting to become a threat to national security if it kept going up.
This correction isn't a repeat of 1980 or 2011. It's policy-driven resilience. Luke Gromen notes that unlike previous cycles, gold now supports national security objectives rather than threatening them. Back then, gold accumulation competed with treasury demand and industrial priorities. Today, it aligns with reshoring production and stabilizing the dollar. Prices above $5,000 indicate that strategic demand is absorbing volatility rather than letting the market collapse. Investors should recalibrate expectations. Bullion is now a policy asset, not just a hedge. Next, Luke Gromen explains why these fundamentals suggest a longer, structurally supported bull cycle in precious metals.
You can read as much when Volcker said gold is my enemy.
Yep.
2011, that was still, Wall Street still dominated policy circles in Washington. And so gold's going up and up and up and up. And hell, they didn't mind it 2008 to 2011 because it told them, it was giving off a message of inflation and et cetera. That helped them get out of that crisis. They needed to inflate for a while. But once it got to a certain level, they didn't like that as much in terms of the message. They need it higher now for multiple reasons. If they want to reshore, if America does not want China to make the majority of its weaponry for America within 5 years, then America needs the price of gold a multiple of where it trades today. 60% higher to a multiple, 160 to, I don't know, 400, 500% higher. I don't know what the right number is. I can offer different perspectives on that. But it is so different now versus those periods of time. Now, people say, oh, it's never different this time. It is. You're right on that level. It isn't different this time. 1973 to 2020 was the only time in world history where the debt of an insolvent sovereign served as the primary reserve asset for global trade.
The gold market isn't just responding to investor sentiment. It's being reshaped by national security imperatives. Luke Gromen emphasizes that US needs gold multiple times higher than today to reshore critical production and prevent dependency on China for defense assets. Historically, from 1973 to 2020, global trade relied on insolvent sovereign debt as the reserve, creating a distorted system. Now, gold becomes a strategic reserve asset, with the price directly influencing supply chain security. Investors should recognize that policy, not speculation, is the dominant driver this cycle. Next, Luke Gromen details why this reversal sets the stage for unprecedented bullion demand.
That was the anomaly. We're just reversing that. And so it's really, I think, the biggest, in 2017, I called it the biggest mean reversion trade in history. A couple different presentations I did with gold at whatever, 1,100, 1,200, 1,300 bucks. So I think gold, I think it is different than the last 50 years, but it's no different than what it was the prior 5,000 years. And ultimately, when you look at the imbalances as they exist, the United States needs gold way higher than it trades today. But by way of comparison, people say, well, oh, China, mercantile, and they're globalist, mercantile. China would sit down at that same table with Michael Every or anyone accusing them of mercantilism and say, look, we shipped all this stuff. And oh, by the way, we're not necessarily manipulating our currency. We've got factories that are like literally running dark, running on AI. We have made massive productivity enhancements. And so we're just more productive than you.
Yep.
And that's just a fact. But, Mr. Every, Mr. accusing us of global, and I'm not picking, Michael's a friend of mine. So here, but anyone accusing them of global, mercantilism, China imported 975 tons on net of gold last year.
What many label as Chinese mercantilism is actually a disciplined accumulation of gold as a neutral reserve. Luke Gromen points out that in 2025, China imported 975 tons of gold, reflecting strategic hedging against the dollar rather than currency manipulation. Historically, gold has been the global settlement asset for 5,000 years. The last 50 years were an aberration. For investors, this underscores that the physical gold market is now driven by real-world trade imbalances, not speculative cycles. Policy and productivity are shaping bullion demand more than headline-driven narratives. Next, Luke Gromen explains how this creates structural pressure on the dollar versus gold.
And so if I'm China, and I suspect this is what they're saying to Trump and Bessent and what they said to Yellen before them, was listen, stop. We are importing 975 tons of gold. The issue is not us overproducing with the left hand. The issue is that you are overvaluing the dollar relative to gold with the right hand.
Mm-hmm.
We ran a 1.2. So think about this. The Chinese ran in 2024 a $990 billion surplus with the world. It was the biggest surplus in world history as a percent of global trade, global manufacturing output. Biggest ever, 990 billion. Okay. China needs to strengthen it. They're manipulating their currency, blah, 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 mercantilism, blah, 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 blah. The yuan strengthens sharply against the dollar, biggest move against the dollar in a long time. First half of 2025 was the worst drop in the dollar in 55 years. And yet in 2025, guess what China's trade surplus with the world was? 1.2 trillion, up nearly 25%, despite a much stronger currency. Okay, what's the real issue? The real issue is the dollar's wildly overvalued against gold. And I highlighted this in 2024, I highlighted it again in 2025. If you take the $1.2 trillion trade surplus of China and divide it by the 975 net tons of gold they imported.
China's record trade surplus isn't about cheating. It's a signal of dollar mispricing versus gold. Luke Gromen emphasizes that even with the yuan's sharp appreciation in early 2025, the worst dollar drop in 55 years, China's $1.2 trillion surplus grew 25%. The key insight is that the real imbalance is the dollar being overvalued relative to gold, forcing China to accumulate nearly 1,000 tons annually to maintain purchasing power. For investors, this reframes gold as the true global settlement asset, with currency swings secondary to structural bullion flows. Next, Luke Gromen explores what this implies for gold's ultimate price target.
It values that gold to balance their trade at $38,220. At $38,220, China runs a flat balance of trade. What's the implication? The dollar gets waylaid.
Right.
The gold is now the reserve currency. America, they whine about this. These American economists whine about this mercantilism. Listen, there's two sides of the same coin. If you want the Chinese to stop being mercantile, price your currency appropriately. The dollar is so overvalued against gold relative to what we make useful in the real world. And that's the issue. And so when we say globalism's over, yeah, I agree with Michael on that. What's that mean? I don't know if 38,220 is the price, but I think gold is going to somewhere between 5,000 where it trades today and 38,220
Right.
to balance the Chinese trade. That's until the dollar gets weak enough that people, say, hey, I can actually make more of a living as an engineer making something instead of like trading monkey JPEGs back and forth, or I can, day trade my stock account and make more than an engineer can. You get the dollar weak enough that we can make stuff here. And that's how you do all of those things. Is you settle in gold and you just let US's trade deficits bid gold to the moon until the dollar is appropriately valued, which is probably, I don't know, by the end of the cycle, I think DXY trades in the 60s, maybe lower. That's where this has to go.
Gold is effectively the global balancing mechanism for trade imbalances, not just a commodity. Luke Gromen explains that at roughly $38,120 per ounce, China could flatten its trade balance, demonstrating how overvalued the dollar is relative to bullion. This reframes US deficits. They aren't structural failures, but automatic drivers of gold demand. Investors should see that until the DXY weakens toward the 60s, gold will remain under upward pressure, with price swings reflecting strategic settlement flows rather than speculation. Next, Luke Gromen details how this dollar revaluation cycle could reshape manufacturing incentives and domestic production.
And what general time frame are you talking about here? Because I just don't want folks to get the impression that Luke is saying, okay, gold's going to $40,000 an ounce tomorrow, right? So are we talking a half a decade? Are we talking 2 decades? Like just finger to the wind. What wouldn't surprise you?
See, I don't think it matters. Like, this is a problem with a lot of American investors. They only buy stuff when it goes up, right? American investors only buy stuff that goes up. Now, I think it's going to happen. I think it has to happen over the next 5 to 10 years. And you say, well, gosh, is that fast enough? Here's a reality. I put up a chart yesterday. It showed if you look at the S&P total return, right? So this is the S&P with dividends reinvested. Gold has outperformed S&P total return over 1 year, 2 year, 5 year, 10 year, 20 year, and 25-year basis. Basically, my entire career, I'd have made more money sitting in gold than in owning the S&P 500 total return. The only time it worked was in 2011. If you bought it 15 years ago, S&P total returns killed gold since then. Other than that, sort of every major, and that was before we really started this change. Like, I think we are in the very early innings of it is a matter of national security for the US to settle.
Many investors panic over timing, but the trajectory of gold is driven by structural imbalances, not short-term market moves. Luke Gromen highlights that over 1, 2, 5, 10, 20, and 25-year periods, gold has historically outperformed S&P 500 total returns except for select intervals like post-2011. This suggests that long-term wealth preservation is increasingly tied to bullion as a strategic asset, not speculation. With the first steps of a national security-driven trade shift underway, US portfolios ignoring gold risk missing systemic upside. Next, he outlines why this national security lens changes expected price ranges.
Trade deficits, at least partially in gold, because we need the price of gold higher. We need the dollar weaker. We need defense industrial production back here. We don't want to be reliant on the Chinese to both finance our military and make our military. It's a bad idea. And so the only release valve is gold. And so I think ultimately, look, where's it going? I think it's probably going 15 to 25,000, probably over the next 10 years. When you look and say, okay, a triple over 10 years, that's not bad. A quadruple or a quintuple over 10 years, take that all day long. Now, from here, I think it's going to be more volatile than it has been because I think we're getting into that part of the cycle. And look, if I'm wrong, then the Western sovereign debt is unsustainable. And oh, by the way, the only thing you're going to want to own in that case too is gold.
Is gold.
Gold isn't just an investment. It's the only structural safety valve for US economic and defense security. Luke Gromen forecasts $15,000 to $25,000 over the next decade, reflecting systemic pressures from trade deficits, dollar overvaluation, and the need to reshore critical production. Volatility will rise as these imbalances play out, but the underlying driver is strategic necessity, not speculation. Even if Western sovereign debt collapses, bullion remains the default protective asset. Investors should consider gold as both a hedge and a long-term wealth preserver.